Canada stands at an economic crossroads, facing an array of challenges and opportunities. While Canadian entrepreneurs and businesses have proven resilient time and again, the reality is stark. The country is underperforming, productivity is stagnating, and growth prospects remain constrained. This marks the third consecutive year of underwhelming growth, raising concerns about a deeper long-term malaise. What's driving this sluggishness? Well, there's no single villain here. It's a storm of productivity stagnation, demographic shifts, and external pressures like looming US tariffs. To truly understand the state of Canada's economy, let's dive into the statistics that shape this uncertain future. If you enjoy our content and want to support us, consider making a small donation using the link in the description. Every contribution helps us bring you more in-depth, data-driven stories. Inflation, once a runaway concern, has cooled significantly and is expected to remain within the Bank of Canada's 2% target through 2025. That's good news for interest rates, which peaked at 5% in 2024 after a cycle of aggressive hikes. The Bank of Canada is projected to continue cutting rates in 2025, likely settling around 2.75% by mid-year and perhaps even 2.5% by the end of 2025. Lower interest rates bring hope. Consumer spending and residential investment will rebound as borrowing costs ease, but the pace of economic growth remains slow. Canada's GDP is forecasted to grow by just 1.5% in 2025, up slightly from 2024. However, this is growth well below Canada's potential for the third year running. It's worth noting that interest rates, while easing, have left a lasting scar. Canadians now face staggering debt levels. Households hold the highest debt-to-income ratio in the G7, with interest payments consuming nearly 2/3 of total debt servicing costs. Even as inflation slows, prices will continue to rise, just at a more sustainable rate, leaving households constrained. Since taking office in 2015, Trudeau's policies, centred on increased government spending and deficits, have failed to deliver the promised economic boost. Critics argue that Trudeau's focus on short-term social spending has come at the cost of long-term investments in infrastructure, innovation, and productivity, leaving the Canadian economy ill-equipped to face future challenges. Labour market dynamics add another layer to this complex picture. The unemployment rate climbed to approximately 6.8% by the end of November 2024 and is expected to peak at 7% before easing later in 2025. Wage growth has finally outpaced inflation, offering some relief, but businesses are holding off on major hiring due to economic uncertainty. Adding to this is a slowdown in immigration, with the working age population expected to decline by 450,000 over 2 years, down from a staggering increase of 1 million working age immigrants in 2024 alone. This population shift will act as a cap on growth and exacerbate labour shortages, particularly as Canada's baby boomer generation exits the workforce. Canada's provinces are navigating vastly different economic realities. Commodity-producing provinces, Alberta, Saskatchewan, and parts of British Columbia, will outperform. Alberta's GDP is expected to grow by 2.8%, supported by new infrastructure utilisation and rising potash prices. Saskatchewan follows at 1.9%, while BC is projected to hit 1.5% growth, up from 0.9% in 2024, largely driven by a rebounding housing market and favourable natural gas prospects. However, eastern provinces face slowing growth as population expansion decelerates and government capital projects wind down. For example, New Brunswick is projected to grow just 1%, weighed down by a weak US demand and subdued household spending. But here's where things get tricky. Canada's heavy reliance on trade with the United States has placed its economy in a vulnerable position. President-elect Trump's tariff threats are a dark cloud hovering over 2025. If a 10% tariff is imposed on Canadian goods, Canada's GDP growth could fall from 1.5% to 1.2%. A 25% tariff could slash growth to 0.8%, and retaliatory measures could result in a -1% economic contraction. While these tariffs remain uncertain, their mere potential creates instability. Businesses face impossible decisions: ramp up inventories to hedge against trade disruptions, or delay investments until the uncertainty clears. This precarious situation could weigh heavily on Canada's already subdued business investment landscape. Canada's long-term growth problem, however, predates these trade uncertainties. Productivity, or a lack thereof, remains the elephant in the room. Labour productivity, which measures economic output per hour worked, has flatlined at 0% growth since 2019. In the last 5 years, Canada's productivity has eroded while the United States has surged ahead with annual gains of 1.6%. The gap is glaring. Canada ranks 26th globally in labour productivity, far behind the US, which sits at 13th. The productivity gap between the two countries has grown to a staggering $20,000 per person annually, reflecting slower wage growth and declining living standards. So what's driving Canada's productivity stagnation? For one, business investment has plummeted. Investment per worker has fallen by 20% since 2006, and Canada now invests about half as much per worker as the US. The construction sector exemplifies this crisis. Accounting for 12.6% of all labour hours worked, up from just 8% in 1997, construction has delivered virtually zero productivity growth in over 40 years. This matters because Canada's economy is increasingly reliant on the housing market, which accounts for 6% of GDP compared to just 3% in the US. Meanwhile, intellectual property investment, a key driver of innovation, lags significantly behind. Canada invests 40% less in IP products relative to GDP than its US counterpart. While some service industries have shown glimmers of hope, wholesale trade, retail, and information industries posted improved productivity since the pandemic, Canada still trails the US significantly. For example, the US's professional services sector achieved 3.8% annual productivity growth between 2019 and 2022 compared to Canada's slowing rate. A lack of innovation, compounded by low R&D spending, worsens the outlook. Canadian businesses spend significantly less on research and development than their international peers, placing the country at a competitive disadvantage. Canada's economic stagnation isn't limited to productivity. It's also visible in GDP per capita. Between 2022 and 2023, Canada's per-person GDP fell by 3.4%, marking an unprecedented per capita recession. The economy is shrinking on an individual basis despite strong population growth. Canada's GDP per capita now trails the United States by nearly 29%, reflecting weaker incomes and living standards. In the OECD rankings, Canada has slid from being the 6th most productive economy in 1970 to 18th in 2022. One might assume immigration would be Canada's saving grace, but recent trends tell a more complicated story. Over 7 million people have immigrated to Canada since the turn of the century, many of them well-educated and working age. Yet businesses have failed to capitalise on this demographic boom, investing disproportionately in low productivity sectors like construction and real estate rather than high-growth industries. Meanwhile, reliance on non-permanent residents in low-paying jobs has contributed to Canada's sluggish productivity growth. Canada's business investment crisis exacerbates these challenges. Since the 2008 financial crisis, investment in manufacturing has collapsed, while oil and gas investment remains far below its peak levels. This decline has left Canada's stock market heavily weighted towards low-growth sectors like energy and materials. The Toronto Stock Exchange, despite keeping pace with global indices, significantly underperforms the US S&P 500, which has soared due to innovation and tech dominance. For context, $1,000 invested in the S&P 500 in 2000 would now be worth $6,000 compared to just $4,400 on the TSX, a 35% difference. Adding to the pressure is Canada's fiscal outlook. Government spending has ballooned, pushing deficits higher and raising the risk of future tax increases. Meanwhile, Canadian businesses face the highest combined corporate profit tax rate in the G7 when dividends are included, further discouraging investment. Canada's marginal effective tax rate is set to rise again by 2028 as temporary depreciation measures phase out, worsening the investment climate. Despite its vast natural resources, Canada's potential remains untapped. The country boasts the third largest proven oil reserves and is the fifth largest producer of natural gas, yet regulatory hurdles and infrastructure bottlenecks stifle growth. Ports rank among the slowest globally, with average turnaround times of 2.5 days, placing Canada 103rd out of 113 countries. Internal trade barriers, akin to a 20% inter-provincial tariff, add further inefficiencies, costing the economy billions annually. The consequences are tangible for Canadians. Income and wealth inequality have grown sharply, with the top 20% of earners controlling 40.3% of disposable income compared to just 6.1% for the bottom 20%. Housing affordability is at its worst level in 40 years, and household debt burdens continue to climb. Young Canadians are particularly disillusioned. Nearly 73% expect a recession in 2025, and 56% report anxiety about climate change affecting their mental health and future prospects. Yet, Canada is not without hope. The country's strengths, its educated workforce, abundant resources, and proximity to the US position it for a turnaround. Boosting productivity, however, requires bold action. Harmonizing building regulations, reducing trade barriers, and incentivizing business investment are critical steps. Closing the productivity gap with the US could add $20,000 in GDP per person annually, restoring prosperity and improving living standards for all Canadians. Canada's economic challenges are deep, but they are not insurmountable. With decisive reforms, the economy can reverse its decline, unlock productivity gains, and reclaim its position as a global leader. The time for complacency is over. The time for action is now. If you enjoyed this video and want to see more content that breaks down complex issues with sharp analysis and a touch of humour, don't forget to like, subscribe and hit the notification bell. And if you really want to support us, consider sharing this video with your friends. It helps us reach more people and keeps us motivated to bring you the facts no matter how hard they hit.